we can take the volatility. We can take the risk because we're a long-term investor. Humans are quite fallible, myself included. You know, you get greedy and you get scared. And that to me is risk, right? Is you want to have an insurance policy that when the wild comes, that you don't do stupid things. 93% of active managers lose to a free passive investment. So why would we pay money for a worse return? It just doesn't make any sense.
Mike Green here for Real Vision. I'm incredibly excited today to sit down with Marc Levine. He's the chairman of the Illinois State Board of Investment and is a very vocal proponent of the passive investment style, particularly as it relates to the pension plans here in Illinois. I'm really looking forward to getting both his background as well as his insights in terms of passive investing, and I hope you enjoy it as much as I do. So I'm excited to be here with Marc Levine. You are a credit manager. You were a structured credit manager before.
Right. So I really grew up in the structured finance world. I came out of business school back in 1990 and worked for a couple of Chicago banks. And some folks, older folks, remember Continental Bank, which became B of A's corporate bank, and Chicago Corp, which got swallowed up by AB and AMRO. It was so fun back then because we were really inventing new securities as we went along. So you were doing the first ever of its kind, almost every deal you did. Right, so I did the first ever medical equipment leasing transaction, the first ever securitization of precious metals, and the second mainframe computer leasing, so that kind of thing. And it was an enormous fun. We early on realized it was just a ton of work. Everything got rated, and that was everything was new again. So selling these deals to investors just was a lot of work. So my at the time boss and later partner, we developed a structured investment vehicle that was medium-term note funded, so match funded, which was unique, first of its kind. And really for basically 20 years, that's the way I financed most of my business. Back in kind of early 2000s, I was actually the co-founder, majority owner of a firm, Chicago Asset Funding. Same thing, some advisory business, but mostly the idea was to execute transactions, always off-the-run type assets, and finance them through these structured investment vehicle. And actually going into 2008, we had been fortunate enough to not get ourselves in any trouble. So we hadn't done any of the real garbage, the subprime mortgage paper, the corporate derivative paper, which blew up on everybody. And so we had really good assets. So what we did in late 2008 was actually transitioned from beautiful kind of corporate type assets like I'm describing, trade receivables, equipment leases, into the asset I really loved, which I've done a bunch of deals in myself, and which is CLOs. Okay, so CLO is a portfolio of senior secured loans, mostly to leverage tend to be private equity owned businesses. And so I just love that asset because I was look, we're talking, this is the crisis. I mean, we're putting probabilities on a depression. And you got first claims on these great industrial businesses across America and for that matter, across the world. And the paper we were buying at the time had nice credit enhancements. So we might sit behind, we'd sit behind a senior tranche, but there'd be big chunks of equity underneath us. And originally we're buying that for 40, 50 cents on the dollar. And then in the first quarter of 2009, really kind of all hell broke loose. And some of that paper, there were days when one of our trading partners, Wachovia, actually told me that Marc Levine was the only bid in the world for Mezz CLO paper. We could buy some paper literally in single digits. Anyway, then of course the clouds sort of went away in the second, kind of 2Q, 3Q of 2009, and the stuff snapped back like that. It was like so quick and pretty remarkable.
I want to actually just rewind a little bit because for many of our viewers and for most Americans, I would suggest that structured finance kind of picked up this really nasty
Yeah.
perception. But just to be clear, like really all you're doing with structured finance is you're saying we're going to take the idiosyncratic risk of each individual loan to an equipment manufacturer, whether it's medical leases or it's auto loans or mortgages.
Or mortgages. Sure.
And we're going to combine them together so that instead of an idiosyncratic risk about Mike Green paying his mortgage or car loan or a particular manufacturer being able to collect on the receivables associated with equipment that they've sold, you spread that out and instead you effectively are able to diversify those risks, those idiosyncratic risks, and then you can start placing bets effectively on the waterfall type properties of each of those individual components, right? So there's nothing nefarious or bad about it, particularly when it's done in a traditional credit underwriting standpoint. You're actually lowering everybody's costs in terms of credit as you do it and improving their access to credit, which facilitates a lot of positive activity. The crisis and the nasty dynamics of it were unfortunately where the machine got reversed, and basically the demand for structured products and the demand particularly for RMBS, residential mortgage-backed securities, was such that people started creating credit to fill this machine, right? Does that feel fair to you?
It feels completely fair. The process of securitization and the asset-backed securities industry, where it started out, was really a wonderful thing, exactly the way you described it. So Lou Ranieri's invention of the mortgage-backed security lowered mortgage interest, lowered mortgage payments for all Americans, and now really, everyone sort of across the world. I mean, it was a wonderful, wonderful thing for all the reasons you were just describing. And all the business that I did really were these fundamental deals, raising capital for businesses. They might be a consumer finance business, it might be a commercial business, but right where you brought in that actuarial attribute, where you can now, you don't know who's going to default on an auto loan, but some guys will. So if you put a load of them in a pool, and then let's say the originator of that, maybe that's GMAC, okay, would hold back 5%, 10% at the bottom, okay, at the bottom of the capital structure. Suddenly you've got a beautiful, piece of paper, right? That's just totally money good. The problem, okay, is I like the way you put it. I think of it as resecuritization. All of this synthetic activity, which really does center from a investor-driven type model. That's where really all of the problems were, right? And we had this incredible situation where mortgages were actually, everybody knew they were being originated in a fraudulent way. I mean, it was willful. It was everybody completely aware, rating agencies aware, the investment banks, et cetera. And yet to just the machine, was it Charlie Prince at City? It's like, when the music's playing, you got to keep dancing. Well, that's really not your job, okay? It's to use your judgment. And we avoided all that stuff. And that is where the whole world the whole global economy came crashing from that kind of real garbage paper.
From the hedge fund space, from firms that perhaps had been more involved in the traditional business and were more exposed than you were. The big fear was actually redemptions, right? Everybody was convinced that coming into, and it's the timing is illustrative, right? So most hedge funds have liquidity somewhere around a month, in some cases a quarter, right? And as you came into the end of February, basically everybody on the planet that was running a hedge fund in one form or another figured that they were going to have to provide tremendous amounts of liquidity. And so everybody was trying to sell paper to raise liquidity.
Yeah, so our experience with all of that was originally there were markdowns on really all assets. And as I was referring to before, mezz CLO paper, so junior tranches in CLOs, and even some first pay CLOs, were being marked down initially to call it 70 or 80 cents, right? And what was happening there was, and by the way, all the guys in Big Short, right? They all got out of their trades mostly at kind of 70, right? You had your big upside. Now there was a lot more down to come, okay? But what happened was, what we saw in the marketplace was when that paper originally got marked down to, let's say, 70, a bunch of hedge funds, right, with this There's not great balance sheet, right? Redemption, with all this redemption risk, came into the market. We're buying what was beautiful paper from a credit standpoint, absolutely par bonds. You just don't know when it's going to happen. They're buying at 70 cents, and guess what? Within 3 months, it was being marked down. Their investors started hitting the exits, and that's really where my firm came into play. Is we were able to buy assets in these auctions that were forced. I mean, in some cases, literally forced redemptions. Yep. And that's where a beautiful par piece of paper you can end up potentially buying for 10 cents. I actually, once this was all done, I really needed therapy to kind of, I will never be able to live through anything like that again. I'd love to. It was such an incredibly invigorating environment to live in. You didn't really know how things were going to end, okay? But I had a lot of confidence that a portfolio of senior secured loans, right, again, where you can suffer some defaults, even some low recoveries, and you're going to be okay. We were in really, I think, the best spot.
Very successful, very proactive in your management of your firm and your exposures into the 2008 and post-2008 environment, taking advantage of the opportunities that many others couldn't because of capital. And then you transition into the political sphere. Why? I mean, this is, you ran your own firm, you got to make your own choices, and now you're in a situation where you are managing a $22 billion pension plan that is 40% funded, and as a result, it's extraordinarily difficult. You certainly can't fulfill, the objectives of 100% funding, and so it's a bit of a thankless enterprise. Why? Why do it?
Where the politics kind of all started for me was I felt like I wanted to give back, and I didn't know really how. And so the first thing I did is I looked at this pension thing, and I said, I've just spent my entire career explaining very complicated financial structures to CFOs and treasurers. And in a way, what I tried to do with pensions was the same thing. Right? A public pension is a very complicated financial structure. Mm-hmm. And I thought, geez, maybe I'll be able to explain it to the media and legislators and make some progress. So I started writing a little bit, I met Bruce on a panel, and anyway, and later on he appointed me to this position, to the board, and the board elected me chair. You look for ways to give back, and I really felt like, look, my skill set was, working in the sort of, again, kind of work. I spent my entire life in the financial markets. I was an accountant before I went to business school. I was at KPMG, so I have an aptitude for this, and I really thought I could add some value. And so I kind of raised my hand. I said, geez, it'd be fun maybe to try to help out on the pension investing front.
So trying to solve the challenges associated with the Illinois State Pension Plan sounds anything but fun, but you've chosen to focus not on solving the problem, but instead on managing the asset. And you've had some really strong articulated views associated with that, particularly around the use of expensive hedge funds or various other vehicles. And could I get you to talk a little bit about that?
Of course. Yeah, so we can start. We'll start with hedge funds. I didn't really have any agenda at all when I first joined I'd seen these pension funds. I was always very curious where are the 2 and 20 for assets you can buy on a screen, but I'm like, all right, well, maybe there's something here. I read in the paper about all these proxy contests that the activists ran, and that seemed really interesting. And it seems like, they were winning proxy contests. I didn't know what they were doing vis-a-vis investing. But we took it, our board kind of started exploring the space. We just started asking some questions, really. We had this thing, one of our trustees wanted to have a hedge fund day. All of ISB, the Illinois State Board of Investment, I'll just refer to it as ISB going forward. So ISB had a 10% allocation to hedge funds. Most of those were the stock picking variety, okay? And it's super important in the hedge fund space to divide up the traditional kind of trading book guys from the stock investors. Anyway, we had a 10% allocation, and we invested them through fund-to-fund structures, and there's nothing wrong with that. But that gets beaten up a lot. I don't think there's anything wrong at all with using fund-to-funds, not at all. I mean, you want experts to be making decisions, right? So 10% allocation, and we looked at the performance, and first we realized they're really just stock pickers, right? We talked to the fund-to-fund managers, and they went through. We had 81 hedge funds, which is just a ridiculously long list.
And at the time, assets were $14 billion or $15
correct.
billion.
Yeah, that's right.
So
That's
about $1.5 billion allocated across 81 managers. No particularly large exposure to
no large
anyone.
exposures at all, and all the names you'd expect, and certainly better than average, better than HFRI averages, right? But HFRI, I mean, that's, if you're a stock picker, you're investing in equity markets. I know you're going after absolute return. I don't quibble about that. It's great. That's actually the way you can create alpha, is don't try to beat a benchmark, try to just invest brilliantly. And but the fact of the matter is, they are investing in the universe of the vast majority of our hedge funds were investing in the in stocks, and so we choose to compare that to a stock market benchmark, which I think is the most obvious thing in the world, right? They had net exposures of 60%. I'm like, okay, net exposures of 60%. Let's compare it to 60% of the stock market returns, and it was absolutely remarkable. The returns of this big group of 2 and 20, mostly 2 and 20 funds was about an index fund before fees. And the fees we estimated were, these are the fees of the underlying hedge funds. The fees were about $60 million a year, right? So that doesn't make any sense. I mean, we're getting index funds return. We can get indexes for free, and we're paying $60 million a year. That fails on so many fronts. Not only do I need alpha, I need a fair pie split, right? I need our interests need to be aligned here. So, but we decided not. So we look at it like, let's not do all of this. And what we decided to do initially was, it's like, look, maybe there's something here. So instead of going from 10 to 0, we went from 10 to 3%. And I'm really glad we did that. Right, because we learned so much doing that, and our portfolio is much better today because we took that initial step. We are at 0 now, but what we ended up finding was that inside of our 81 hedge fund portfolio, there were some really great managers, guys who had produced true alpha over a real benchmark. Right, we benchmark them right, and we could look at them over 5-year periods, 10-year periods. Okay, so we could maybe capture some Lehman, some of that funkiness back then, and capture that shorter term after the AUMs had jacked way up, right? Because you want to see guys performing, sort of with their current asset sizes. Anyway, there was a lot, like hunks and hunks of alpha, hundreds of basis points of alpha. Like, okay, well, this feels kind of fair. What we ended up doing was moving the guys who survived, and I'd say about 7 or 8 survived, okay, out of 81. And average alpha, I'd say, is over 500 basis points. We ended up moving them to our equity book because they picked stocks. So we benchmark them correctly. They're in our equity book. We pay them high fees. And we don't need this artificial hedge fund, right? We're happy to do it because they're great managers, not because they're structured as a hedge fund. Being structured as a hedge fund is a negative, not a positive, right? It's a negative because, first of all, if we give money to a traditional active manager, the stocks are held at our custodian. We can vote the shares. We have much more control. A lot of these hedge funds, as you well know, had all these gates, and I mean, it takes 2 years to get your money back. You're not actually liquid. So that's been our experience, and there absolutely are great managers out there, and we've got several of them in our portfolio.
And so when you put them into your, so what did you replace them with? You replaced them with index exposure? Initially,
We moved the allocation, right? We went from 10 to 3, and we added 5 points to private equity, okay? We went from 5% to 10%. And we should chat about private equity, especially when it comes to alignment of interest, okay, and benchmarks. A lot of these things are true there, not quite to the extent of hedge funds, but Anyway, we're now down to 7, where we've ended up really when you net sort of the 2.5 years since I was elected chair and we kind of started this whole process. We've massively shortened our manager roster, indexed a ton, okay? Able to think. Now we got a much simpler book, right? I come out of structured finance where everything was overly complicated. Okay, now I really want simple, right? And I think our board really appreciates that. So now that we can think, we've ended up actually putting an 8% allocation into an asset class called opportunistic credit, right? So I'd say the bulk of the hedge fund reduction has gone into a different opportunistic asset class, right? But this one has risk profile that's much lower risk than equities. It tends to be kind of first lien on asset, mostly commercial, but consumer assets as well. And right, and actually we have target returns of about 11 or 12%, right? So which are higher than I think any rational person would expect out of the equity markets going forward, sort of given where we are today. So that's really what we've done.
In the overweight towards equities, right, which as you correctly highlighted, and I know as I can feel you pull back, right?
Let's go.
In the overweight towards equities, that's a very public pension phenomenon. We were talking before the interview a little bit about how corporate plans are increasingly funded, and many of them are defeasing, which means they're effectively, matching up their assets and their liabilities, and putting it, purely fixed income terms. So there's no uncertainty dynamic. There's a tiny bit, but very little residual risk, and taking them out of the corporate, risk structure, right? Effectively creating an annuity for the pension holders. The public environment has a very different profile, where the returns that are being sought are far higher, certainly can't be matched up against most forms of high-grade credit risk. There are the esoteric type stuff, but the reality is that the give or take $2 trillion worth of public pension plan assets certainly could not be all invested in the opportunistic credit space. And so they're naturally very overweight the equity markets, right? And that in turn kind of perversely gives them the ability to often state that they're going to have a higher return, right? So when you think about your equity book, you mentioned 11%, which has been close to the historical returns, doesn't seem remotely feasible at today's valuations or anything else. How do you think about the returns associated with that book?
I completely disagree with the characterization.
Okay.
That we're not, that we, and actually for that matter, public pension plans generally, right? Our allocation is very similar to most public pension plans. And I think public pension plans are very natural holders of equity, of public equities. We can take the volatility. We can take the risk because we're a long-term investor, okay? So where people get in all kinds of, where investors get in all kinds of trouble is when they start trying to market time. Market time, we just redid our investment policy, and so I was like the peanut gallery throwing it. It's like, I want to write in there that market timing is for losers. Okay, and in the end, our general counsel actually wrote a beautiful, very articulate line, which essentially says the same thing. Market timing doesn't work. So we're a long-term investor. Endowments actually, it's funny, endowments sort of portray themselves as, which they are, accurately I'd say, as long-term investors. They can hold all this big hunks of private equity and all these super illiquid things, much more so than public pensions do. Okay, public pensions actually have fewer liquidity needs than endowments. Endowments use about 4% of their cash annually to fund college, the operating expenses of the universities. The cash usage of a typical public pension plan, including ours, and we're so underfunded, and we're actually an extreme, is sort of 2.5%. So think about it. Put yourself December 1999, just a terrible time to buy equities. Put yourself December 2007, a terrible time to buy equities. Okay, you couldn't have a worse time. Okay, and in either case, if you're a long-term holder and you don't get crazy when the markets start their wild gyrations, okay, you're better off holding equities. And we are if anything, we're probably a little light on public equities compared to our peers, just a little bit. because you accurately would throw private equity, of course, with. So you sort of add it all up. We're probably around north of 60. You could maybe even throw some of the real estate in there. But again, as a natural holder, not worried about not even really worried. We shouldn't be worried about the kind of the wild swings that do occasionally occur. It's really a great asset class, and it's a great asset class today.
So endowments are absolutely required by law to distribute roughly 4%, right? It's part of the process of maintaining their tax-free status. So they have to have that liquidity. It's not necessarily going into university operations per se. It's typically going to fund tuition, scholarships, et cetera. But public pension plans actually have a liability, an asset liability matching function, right? And most, certainly if I look out in California or in New York, most of those have actually now entered into a negative cash flow standpoint, right? Where they are distributing much more like an endowment, except even more extreme. They are net distributors of their asset pool to their pension holders. Is that not the case here in Illinois?
No, that isn't the case. What you described is the case. I would just take issue with one word you used, that it's actually not larger than endowments. The cash needs again, we're a very underfunded pension system. I've looked at other ones in Illinois, et cetera, is again sort of 2.5%. That's not a big cash draw.
Right, but how does that change in 5 years, 10 years? I mean, it depends obviously on the quantity of assets that you have.
Right, so as long as the state, look, Illinois gets beaten up a lot, and a lot of it is deserved, okay? But the fact of the matter is, the Illinois state government and taxpayers have stepped up to the plate here and have, I am sure I can say this, although I haven't really checked it out across 49 states, the largest percentage of a state budget in pension contributions there is, right? I was telling you before, close to 25%, okay? So that, it's almost like the agony, the budget agony has kind of, in a way, already taken place. It's going to continue, and it puts all kinds of pressure on taxes, of course, on other spending. But the fact of the matter is, as long as the state continues to make its contributions, then that'll continue. And there absolutely is a use of cash, okay, as I've said, but it's not some massive, there's not 10% pouring out. Now, there are absolutely some pension systems. In fact, there's a local one here in Chicago where the annual benefits are a third of the assets. I mean, that would actually be irresponsible, frankly, in my view, to be invested in pretty much anything remotely illiquid, and you'd probably want to have a smaller, much smaller equities, and because that time horizon just really doesn't work terribly well.
Well, and we see that. Obviously, Illinois, as long as you continue to devote 25 to 30% of your state budget towards pension contributions, there is an offset there, right? I mean, that's not, it is the equivalent basically of students paying their own tuition, right, to offset some of the costs of running the university. But there are increasingly systems like the Dallas police officers or others where, you are seeing an acceleration in retirements and an acceleration of the claim on those assets because of uncertainty about the ability to continue to make those contributions.
Right, and every pension system is different. Here in Illinois, we have a state constitution that's pretty clear that you can't diminish or impair benefits. And there was a 7-0 Supreme Court ruling, let's see, about close to 3 years ago now, 7-0, right, that sort of validated that, and in fact, you can't even really reduce benefits that are accruing going forward, which is remarkable. And again, you've had a state that sort of has stepped up to the plate and made its contributions. Didn't always in the past, okay, but has over a very difficult period where the percentage of the budget's gone up, really massively. So, again, just speaking for the large Illinois state pensions, okay, we absolutely are a long-term investor. And from what I see with whether it's Wisconsin or Texas, certainly any of the states like the Sun Belt states that are growing, those are right. Dallas is an interesting example. It's just so terribly mismanaged. So that risk is always there, and we'll talk about indexing soon, and that'll come into play big time. Yeah, so that's we are a long-term investor. If you're a long-term investor, you can experience the cyclicality that is just inherent in the stock market. It's going to happen.
So I actually completely agree with that. And I think that is an important distinction. If you're a long-term investor, it's not even that if you're a long-term investor, it's if you are a continuous investor, right? So the volatility associated with assets works with equity. Volatility is your friend when you're investing, but when you move to harvest, volatility becomes a real problem, right? Because if you are experiencing volatility as you invest, your cash buys more in periods of high volatility or low prices, right? You buy more cheap assets, right? When prices are high, you don't buy as much, right? Physically, in terms of the quantity of the assets.
Right. The way I, now I'm really speaking more of Marc Levine personally, the way I see risk, I don't work, standard deviation, which is what volatility is a perfectly fine proxy, but it's really not risk. Risk to me, most investing comes down to behavior, right? And to me, risk is, what is the risk of a market movement, sort of something significant happening that then affects your behavior as an investor? So the best example of this is you get so scared, okay, that equities have dropped by 50%. It's like, I can't take it anymore. And you're selling the S&P on a P of 8, right, in March of 2009. Okay, that is, so you as an investor, that's why no one really does 100% equities. It probably makes sense to do 100% equities. Warren Buffett is going to do 90%, right? He's going to do 90, right? His estate is going to be 90% S&P 500 index, right? And but he's going to lock it down so it really can't be touched. Humans are quite fallible, myself included, okay, that, you get greedy and you get scared. And that to me is risk, right? Is you want to have an insurance policy that when the wild comes, that you don't do stupid things.
That I think is absolutely correct. That the true risk is that you're forced to basically not play the game in the next round, right? There's actually some remarkable academic research that's come out in the past couple of months that looks at the distribution of outcomes in terms of wealth, et cetera, and looks at things like the equity risk premium. And what it correctly articulates actually or what it highlights, is that if you think about the equity risk premium from the standpoint of like a log normal distribution, and there's some extreme outcomes on one side, and there's some extreme outcomes on the other side, it's very difficult to explain an equity risk premium. But the real rationale for why the equity risk premium exists is because events are linear in time as compared to random in time, right? And so if you have adverse events that occur, it destroys your flexibility to make future events, right? It's another way of saying it is, if you start off your career early and you suffer a series of devastating setbacks, it's extraordinarily difficult to become rich, right? But if you start your career off, you don't graduate into a recession, you have a series of fortunate events occur, it becomes far easier to have favorable outcomes almost regardless of what happens next, right? You've accumulated a stock of safety capital, you don't have to put yourself into debt to pay your living expenses, et cetera, right? The risk for an Illinois or an endowment or anyone else is that we effectively are reliant on that continued inflow coming from the state budget, right? And so Illinois is a very high tax state. It's experiencing negative population pressures, right? And so ultimately those fixed costs of servicing those pensions, making those contributions, by definition are going to consume more and more of the budget over time, barring extremely positive economic outcomes, which are, again, by definition, increasingly difficult when you have negative population pressures.
Yeah,
right?
so I thought the same. Okay. And again, what I want to remind you is that and no one ever talks about it, is that Illinois has just in the very recent past, gone through a remarkable period of massive increases to these pension contributions, where now it's soaking up, as I said, about 25% of the state budget. So if you look at the actuarial tables, over the next 20 years, those expected pension contributions, again, assuming 7%, assuming the actuarial tables, yada, 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 the pension contribution doubles, okay? So
it goes from 25% to 50%.
No, because the denominator, right, your tax revenue, your tax base, let's just, hopefully, God willing, you keep rates where they are. They were recently increased. It's still, from an income tax wise, Illinois is not super high. Property tax, it is. Anyway, so you'd expect your economic base to continue to grow, and inflation plays a role here as well. So doubling over the next 20 years, does that put more pressure on the 25? Probably, but not as much as we've already sort of experienced. A cynic might say, sort of the frog was put, right, and you gradually turned up the tap and you boiled him. And that may in fact be where we are. But the fact, look, the budget is what it is. Pensions are 25%. We could sit here and complain about it, but that's where we are.
I mean, the assumptions behind those actuarial tables, right, are challenging. I would assume that they're drawing from the CBO budget forecasts.
The key assumption, though, Michael, is the discount rate, right? So like Josh Rao at Stanford and previously Northwestern did awesome work in this, of all the games that are played across the country in these pension systems with very irresponsible discount rates. So Illinois, the discount rate that the state employs, which is the pension system that I'm the chairman of, and this is actually true of both teachers and State University, which are the other two very large Illinois state pensions. We all use 7%. So, yeah, 7% is not a sort of crazy, irresponsible number. It was 8.5. 8.5 felt very high. Right when it was 8.5, I'm like, geez, why isn't this thing 6? When it's 7, it's like, you know what? You look at what you can accomplish on the investing front, and there's a whole different conversation we can have that, should you really be discounting liabilities that aren't backed by assets? Okay, but the 7% assumption, as far as a rate of investment return, feels okay to me.
What I'm seeing in the equity markets, and particularly as people are flowing into passive vehicles, right, is ironically the same correlation characteristics that occurred within the structured finance market, within the RMBS market. And so I'm wondering if you guys have spent much time thinking about that. Because the February event was an interesting one, and it's one that I had actually made some very well-publicized claims in advance on, that the embedded correlation in equity markets is radically higher than it was 10 years ago, right? Which suggests that the volatility profile is different. And if you think about that, it makes sense, right? Because if everybody's buying the S&P 500, you would expect, and the market is shifting increasingly passive towards those who are buying the S&P 500, you would expect the correlation of those assets to rise, right? And so that's actually what we are seeing. We are seeing the underlying correlation on the market at given levels of volatility is higher and higher and higher. It's about 2.5 times what it was in 2000 today. And as a result, that change, the participation in passive strategies, not articulated that you should necessarily be market timing, but the use of passive strategies broadly diffused has created the same correlations that we saw in the securitized funding markets.
I completely disagree.
Okay.
All an index is, right, is everybody owns these stocks, right? Whether it's, the Russell 3000, which is not quite 3000, or the S&P 1500, right? Everybody owns these stocks, and the active managers all own these same stocks. They just put different weights on them. And what an indexer does is take the sort of the average, right, of all the votes of all the participants and takes a free ride, okay, on all those decisions and puts weights based on an average of the full market, right? That's how market caps are developed. So we're an indexer. We index well over 80% of our public market assets. We do it because it's absolutely the best way to invest. We're buying the same stocks everyone else is. We're doing it at extremely low cost. We don't have manager risk. It's a brilliant way to invest. Look at what we own. Our concentrations are the companies that the market says are the most valuable, right? Have the best prospects, right? You look. I mean, our concentrations are you know them: Apple, Google, Facebook. All bumps aside, right? It's doubled in the last 3 years. So you can always have a story. There's so many stories out there. We use data, and the data is very compelling. S&P S&P's routinely done these kind of 5-year studies where roughly 80%, regardless of what segment, regardless of what time period, that 80% of active managers lose to their benchmarks, okay? And then there was always this sort of fun and games of, well, who are the 20? And the 20 change all the time. And Vanguard and a bunch of academics have done studies on persistence, right? That you can't tell who those 20 are. Well, then S&P went a step further, right? And over the last couple of years, they've been publishing 15-year studies. And the numbers did exactly what you'd expect them to do, maybe even a little more dramatic, that 93%, large cap, small cap, domestic, international, whatever you're talking about, 93% of active managers lose to a free passive investment. So why would we pay money for a worse return? It just doesn't make any sense. It doesn't make any sense. And I'll go a step further. The way we structure our public equities portfolio and the way we're kind of moving into this over the coming months at our board level is we do have some active, okay, but we expect brilliance out of our active. If you don't move the needle, it can't be a basis point. Because we have resources. We have limited, our board meets four to 6 times a year. Our staff, we're a government organization, but the same is true of endowments. Staff don't tend to be paid super well. And building up some big staff, it's really not a winning formula. So why would we do these more complicated things, okay? Why would we do that to accomplish nothing, to get a worse return? So if we benchmark everything right, and if you can produce hundreds of basis points of alpha, then we'll invest with you, okay? And if you think about it, what we're doing is we're making a persistence bet. We refuse to make a reversion to the mean bet, though, right? So if you've underperformed your benchmark for 5 years, I mean, come on, like enough is enough. And we're not going to just go continuously. I wrote this piece about a year ago where Professor Wahal at Arizona State, I quote him in it, had done a study of all the decisions of firing these managers and hiring these, and the ones you hire, their performance always goes down right back to mediocre within a year. There's AUM properties going on here where investors are always chasing kind of the great performer of yesterday, and they might have done a great job managing $500 million. Now they got $10 billion of assets under management. Much harder to do. This is true big time in the hedge fund space. So we index because it's just a much better way to invest.
So it's interesting because when you say you use the data and you're looking at those types of studies, first of all, empirically they're absolutely correct. Right? Mm-hmm. So on you're making 2 separate bets. One is outperformance, and the second is the persistence of that outperformance. It's extraordinarily hard to do, particularly in an environment of low interest rates, right? Because at the end of the day, if you really think about what an active manager is doing, right, they actually are choosing not to invest. They're choosing not to invest along the same metrics as a market cap weighting, mm-hmm. which inherently means that they are making some market timing or cash allocation mm-hmm. call. And if interest rates are below that of their management fees, it's inevitably a negative alpha choice, right? You have to, on average, conservation of alpha, everybody has to be invested if interest rates are below management fees, right? So the data is actually fairly straightforward on this, that the alpha is very positively correlated to the level of interest rates. And the reality is the world we live in is it's quite low now. That is a separate phenomenon, though. Sure, go ahead.
Okay, I think you've got the wrong correlations, though. So 30 years ago, interest rates were much higher, right. And there absolutely was alpha all over the place. Mm-hmm. I agree. to me, the defining variable, and yeah, everyone sort of picks their own, there's been this influx of professionalization into the money management industry. There's just, right there, it was sort of almost a cottage industry back then, let's call it 80s, 70s, you know, the days when Berkshire Hathaway, right, was just completely knocking the, you know, ball out of the park, rather than matching the S&P, which is what Berkshire Hathaway has done over the last 20 years. Right, so I don't think it's interest rates. I think it's the professionalization, right? There's so much information in these prices in stocks that it has created just not a fertile environment for active stock pickers to really make money. The active stock pickers that we've seen make material amounts of money, again, if you make a few basis points, just not worth it, is more of a private equity mentality of concentrate like crazy, okay? Maybe pick 10 stocks or maybe 20 or 30, but pick them based entirely on your absolute return assumptions of the underlying businesses and kind of ride that. That's really been our experience. And we do relatively little of that. Again, we're not going to take big risks on sort of concentrated positions. And so therefore, we kind of end up with the portfolio we have. I would also point out, though, more bad news in store for active managers is, and I'm sure you guys are all over this, is sort of the old smart beta movement, which is now kind of factor investing. That's now absolutely being, that's indexed now. Mm-hmm. So boards can take any sort of view. So if a board wants to, a lot of this ends up being, are you running your investment entity for your beneficiaries or the college, right? Or are you running it for the entertainment of this and the interesting sort of lessons and professional development of your staff, your board members, that sort of thing? You have to be running it, right, in the best interest of the beneficiaries. That may make it more boring, okay? If a board or a staff wants to take a view, now there's this beautiful environment of factors, right? And there's, of course, the big five. There's others. I wouldn't necessarily waste time with the minutia of getting down below the kind of primary Fama-French factors. But those are brilliant ways to express views. In fact, I actually think that when you're structuring a public markets portfolio, what you do is you have a big honkin' core of index, and then you put sort of on top of it, factors come first, and then find your really, truly idiosyncratic, probably private equity mindset type active managers. That, to me, is a public markets portfolio.
So all of those have their own unique characteristics. I've spent a lot of time looking at them, but I did want to actually hit on one point that the statement that you made that I think is an important disagreement, which is you said that when you buy a market cap weighted, or it's really float weighted, it's not market cap weighted, but when you buy a market cap weighted index, that you're getting the average of the participants. So that's not actually true. What you're getting is the marginal participant. Markets are set at the margin, not at the average. And so if I choose not to participate by holding cash, I'm not a market participant, right? It's the person who last transacted. So if the price of Facebook jumps by $5, the market cap rises by $5. There was nothing I did. I'm not an average, right? I'm just a free rider in that process, right? Where it becomes a challenge is if all of the marginal flows are passive, right? And so what we've actually seen is we've seen significant outflows from active managers and inflows into passive vehicles. The passive vehicles are the ones that are actually setting the price now, right? So you're no longer a free rider. You're actually an active participant. You are the driver of the market. It's the same dynamic, I would argue, that we saw within the structured product market where you actually began to influence the housing prices. We won't resolve this.
We're not going to resolve this. I mean, the fact of the matter is that well over half of stock trades have price discovery embedded in them, are made by active managers, right? Index funds tend to trade relatively little, right? And then there's the stuff you really have to throw out, the kind of high frequency trading volume. But I 100% agree that you can't have an environment with no active managers, right? We're just nowhere near that equilibrium point where there's so much passive that there isn't sufficient intelligence in the price discovery, right, of stock trading on the margin. So we just see things a little bit differently there, I suspect.
Well, I think that's going to be the interesting point, is that at some point we will find out where that barrier is. And John Bogle has articulated that it could be 85 to 90%. I think we're already there. I think we're past that point. But if that's the case, right, it's a testable hypothesis. And so we can revisit this in another year or two. And I'd love to be able to do that.
Of course. No, I'm always ready to mix it up on indexing. It's right there. There are assets you can't index, right? You can't index private market. You can't index a thing like high yield. But if you can index, if you can get kind of a free ride and I don't have to do anything. I don't have to use staff. I don't have to do anything, right? I don't have to burden the board, right? In our limited number of meetings, and I can be in the top 7% over a 15-year period. How am I going to find the 7%? There's no way. I mean, it's entirely random, right? There's a whole governance element to this too, that just doesn't get talked about. It's better. A lot of times it's better to do less than more, right? And more can potentially get you into trouble. Do less. Indexing is so simple, wonderful, and do your active management on the margin. That's our philosophy.
It sounds like it's one that's certainly working. I'm excited to hear that there's the state of Illinois has public servants who are actually willing to do what you're doing. And thank you very much. I really appreciate it. Look forward to revisiting it with you in the future.
Very much so, yeah.
Well, Marc didn't disappoint. We got to learn about his background in the credit markets as well as his views on passive. And there were some fireworks. Marc and I disagree on the role of passive and the impact that it's having on the markets. And I'm really looking forward to another chance to sit down with Marc in the future to discuss how our views might have changed and to evaluate how market conditions might have actually validated one of our 2 points of view.